Good morning, everyone, and welcome to another podcast, FarmCon Conversations podcast. Co-host Todd Loechler here in Panhandle of Nebraska with Kevin Van Trump sitting in Kansas City. Kevin, how you doing this morning?
Doing good, buddy. How are you?
I'm well. I hesitated there for a second because I was going to share the fact that it actually snowed here this morning, and I thought, well, let's introduce Kevin first. So, yeah, we got our first moisture in about 5 months now. Out here, have no idea if it's enough to do anything, but I was told by one of our subscribers once in Northeast Colorado, who's on the same sandy soil, she goes, man, it's amazing what a 10th of inch of rain can do. So hopefully there'll be a life-saving event for some of the wheat out here. So anyhow, that's good. The update from the Panhandle. Yeah. Well, I mean, how'd your weekend go? Did you got any exciting news to share? Or was it just another Van Trump grind?
No, we just worked most of the weekend. Nothing crazy. Just same old stuff. Just a ton of work. Just seems like we're behind this time of year, so it is what it is.
It is, but you're just like the U.S. farmer planting this crop. You get behind, but you can make it up real fast because you got big equipment and stuff like that. A good team. No, I was a little surprised to see the number. I mean, let's just roll into corn, bean, and wheat and stuff. I was talking to guys the other day, and I thought we were worse off in the Eastern Corn Belt, and I'm reading what we're publishing, and then man, okay, maybe it's not as bad as I thought, and I'll share some little issues as we get into the soybeans later. But anyway, let's roll on.
You're talking on planting pace?
Yeah, well, planting and then weather issue. Planting because there's still we got there's some frost freeze potential for folks, and I guess the guy in it was Iowa, Indiana, I don't remember, but he said he was just shocked by everybody did beans first in his area. And he's like, dude, man, I mean, these things get emerged, and he didn't know if they all had or not. But and the potential 3 nights in a row where it's going to get near freezing, that's going to potentially. But I get. I mean, I don't think it's that much emergence, and who knows how far the frost line goes. So it was just different.
The risk reward's been worth it in the last few years. I mean,
it seems like it.
Early plant beans have yielded so well. I mean, you have a lot of trying to run some beans early, and I said this many times. I am no way, shape, or form in any camp that is worried about planting conditions.
Right.
My head there. I keep hearing bulls talk about it, and we're running way ahead of pace in the bean side of things, and we're ahead of pace in corn, and you saw how quick Iowa caught up last.
Boy, they did.
And that's what I'm trying to say. I mean, technology has changed so much over the last 20 years. Like 20 years ago, yes. I mean, you could have people buzzing in Chicago to be buzzing a little about all the rain after the heat and this and that, and we're going to be delayed. And I just don't think the market bites on that much anymore, just because of technology and how we're able to catch up in such a hurry. So, I don't see that as any type of major concern. Let's talk about the wheat market first, because we always put wheat last. Wheat's kind of been leading here, and I'm not one to pat myself on the back. I never do, but I will say we were patient for months on pricing wheat, and we had this window out here that we were targeting, this, Feb, March, April, and then we kind of bumped it a little March, April, May, because it didn't kind of come home. But, this is our window, and I'm sitting here today, and, we probably need to make another sale, just put it out there. We need to make another sale in July 27 wheat. You've got that Kansas City July 27 clear up. You press 7. You push north of 725 today. So, I just always try to tell myself, you can get that first 20, 30% marketed at a decent level, and here you sit at $7+, same type in the spring. I think you got to pull the trigger and make some sales and try to reduce some longer-term exposure. I sit here in the wheat market, and, our exports, I could argue that exports could move a little bit higher. The USDA could bump them maybe 10, 20 million bushels higher. Production, obviously, I think there's going to be some production, cuts. Soft red, I think, could get cut. There's some production. There's some production areas that are seeing enough concern and issues that I think you could cut that soft red. And obviously in the hard red, like you're seeing out there in your area, Todd, and some of the other areas out west, I think there's some complications. But at the end of the day, global supplies are ample, and you're still going to have U.S. ending stocks, what I feel like are probably, arguably, a little bit overly burdensome. So, I'm a seller on this rally. I think I'm blessed that the rally has happened and it's come, and it's helped bail us out of some, where we were behind on some sales. But I'm really a believer in, I think, using this rally to reduce some longer-term price risk. Just because of this, I think the war headlines have, added and have had the funds become more bullish overall. You've seen their position in corn and beans, grow to some extent, then defend their position. In wheat, they're still a little bearish, but they were holding a lot bigger bearish. And, we've added the weather premium because it's that time of year for weather premium. So I'm just saying, if the weather premium is taken out of the market, I think it will be here at some point. I don't think there will be as much weather risk. Don't take this wrong. I know there's still problem areas and places where we're going to have, maybe complete crop loss or some type of yield drag. But overall, I think the weather is looking as if it's improving a bit rather than getting worse, if that makes sense. I mean, I think maybe we've peaked with the worst case scenario, and now maybe things are going to get a little bit better. So when that happens, you have that letdown, and the same type of deal with the war headlines. I feel like the war headlines, maybe the war doesn't end or the conflict in the Middle East, there's no major resolution, but I feel like there's been some type of crescendo as far as the craziness that may spin out. Now, obviously, when you're dealing with Iran or Middle East terrorist type, I mean, anything could happen at any time. So I'm not saying it fully goes away, but just like those war headlines we saw when Russia went into Ukraine, we had that major run higher, and then market just kind of became callous to it, and we kind of just drifted back. So I'm worried that maybe some of the headline bulls could become a little callous and we pull back, or you start to lose some of that luster a little bit. So I'm kind of a seller into it. I'm not saying go nuts, but I think you start to nibble and start to feather in some sales out there into 27 estimated production. And then whatever you're comfortable with, in your own production for this current crop, I think you start to feather in more sales there as well. So, that's kind of how we're playing the wheat. And it's been nice to see the wheat take off and rally, and it gave corn a little bit of room and pulled corn higher with it to some degree. We can transition right over into the corn comments, or where my positions are in corn. I feel like it's a similar type of story. You've got the war headlines, obviously, keeping crude oil supported. You've got crude oil up close to – you got Brent's trading, like 104, 105, and WTI here at home's trading close to $100 a barrel, or right around $100 a barrel. And, that's keeping corn, and beans somewhat elevated and as an energy play. And I think we ran that graphic earlier in the week that ethanol compared to gasoline, I think you're at a 20-year low for the price of ethanol versus gasoline. So I think you have a good demand story in corn. There's no question. There are some arguments to be made that the USDA still needs to raise exports higher, but you may see a cut in ethanol, and the feed and residual remains a huge wild card. There's still people out there. There's bears, let's say, that think the feed and residual could be 200 to 400 million bushels too high, and then it needs to get, really cut. I'm not sure that's going to happen, just because, like I said before, the USDA addressed that a couple of quarters ago, and they took that approach and raised it, which I'm not in that camp. I think that got me a little baffled, but so we're sitting here with a good demand story, but I think the market already has that kind of priced in, and at the same time, there's really not a whole lot of a supply side issue. We're sitting here with 2.1 billion bushel ending stocks, which is a burdensome number. You go over to South America, and there are some areas in central and north central Brazil that are starting to create a little bit of talk, and people are paying attention. There's some dry areas where I think you could get a yield drag. and it takes top end off the yield in some of those courses on that second crop, but not enough probably to move the needle much at all in Brazil. Then you go over to Argentina, and hell, I mean, most of the people I know inside the trade are thinking the Argentine crop is going to be 5 to 10 million metric tons higher than the current USDA estimate. I think USDA is currently like 52 million metric tons, and there's a lot of guys talking and folks talking that this thing could be closer to 60 million metric tons. That it's a deal. What I'm reading and what I'm understanding is that they found more acres than they thought that were planted to corn. It was kind of like last year here in the U.S. where the corn acre number just kept going higher and higher on the planted acreage number, and that's kind of what we've seen happen here in Argentina. So there's what I'm saying is we're going to see another record-setting total production of corn out of South America. There's no question. Now the good news is Brazil started to use a lot more corn for corn-based ethanol. They have a little different blend, and they're at a 30 on their ethanol blend, which is a big, substantial difference than here at home, where we're just trying to get E15 year round. So, I do believe Brazil is going to keep more bushels at home, which is helpful. There's no question. But the bottom line is this: another year of record-setting production, and here we are here in the U.S. off to a pretty decent start on planting and sitting on plus over 2 billion bushel ending stock numbers. So that's what I'm saying. There's not really a major supply side story. I like the fact that the funds are bullish. There's no question. And I like the fact that demand is strong. Those are two of the three things that we really need to have a bull market. But without a major weather complication or some widespread weather worry here in the U.S., I feel like we're bumping up towards the upper end of that range, Todd. So I always said, and you've heard me the last several years, I feel like if the market deems we're kind of oversupplied, which is anything I think above 1.8, 1.9 billion bushel ending stock number, I think typically, traditionally, we would trade in the 350, 450 range. Now, here we are, 2 billion bushel ending stock, market you think we're a little bit oversupplied. But you got the funds being a little bit bullish. We've got the war headlines, and we're heading into a weather market. So net, I like to say if that happens, now you can move your range up to $5. So instead of the upper end being $4.50, maybe the upper end becomes closer to $5. Now, if a weather story were to really take place, you would have what I consider all three of your major cylinders firing. And we got a chance to really run this thing higher. And you're talking, maybe you get to 6 plus 650 corn or some type of play like that. But you're going to have a significant weather story come up, that really impacts pollination or something like that. So that's where I'm sitting, thinking we're at the upper end of our range without a major weather complication. If we get a major weather complication, then you could see a lot bigger breakout to the upside, because I think you would have your demand bulls in the market and coming in. You would have the funds continuing to defend and come into their position, and you would also have the weather bulls jump in the trade as well. So I think you could have that. So that's where we like, I like being around 40-50% price right in here for new crop, feather in a few sales. Make sure you're paying attention to that Dees 27 corn, which, I told folks, you're sitting here close to $5. I think we traded just over $5 today. So all the $5 price targets were triggered. And that's what I'm trying to say. I think you got to nibble a little bit out there, feather in some sales, get a decent starting point for 2027. We know inputs are going to be somewhat elevated, so we don't want to let that slip away too much. But at the same time, we have to be aware that if a weather problem comes up, there's going to be more room to the upside. I've seen guys doing mid-max contracts. I've seen them working with their end users, grain elevators and buyers and merchandisers out in their area to try and build a floor and give themselves still some upside potential. And I think that's a smart play right here. Like I said, I think that's the way to do it, but I think you got to be using the rallies to reduce some risk, just because if you have to meet coming up here in China, supposedly. You've got other things. We've got a lot of geopolitical uncertainty. It seems like things could flip on a dime, and if there were more problems or complications with trade, I think you could see this thing step back in a real big way if demand starts to waver or weaken in any capacity. So, I think it's prudent here with both corn and wheat and take some risk off the board.
Well, let me ask you this. As I continue my education, I talk to farmers all the time. I mean, considering the environment, considering the price in the last, 18 months or something like that, considering the current carryout, why would a business-minded operator not go and price some $5 D27 corn? I mean, what would a guy say to me that why he wouldn't? I mean,
there's a lot of folks out there that don't like to price anything until after they've actually had you see the crop grown. They just, I mean, a lot of folks are burnt by listening to people and hedging and following what other people tell them, and their dads. And their dads were burned by it, and it's kind of become, they're just not going to do that, which I think's fine. I think that's fine. What I don't think's fine is flip-flopping around. And so what I mean by that is if you're never going to price till after your crop's grown and you see how many bushels you have, that's fine. You'll catch the rallies later. You see what I'm saying? They probably have a lot of bushels right now, Todd, that they're pricing a lot higher than maybe we were pricing them when we were pre-pricing. So it all works itself out for the people that have a plan, in my opinion. That's why I don't believe in cookie-cutter plans and programs. I think everybody has to design and develop their own so then they can manage their own, and they're comfortable, and they can make adjustments that they understand. That's why I said you got to develop your own golf swing. You got to develop your own swing
right
at the plate in baseball, and then once you have that, then you can work from there. I think it's bad to just follow people blindly at things, and so I totally understand why people wouldn't market any or forward market any, and I totally respect that. For me, though, just like I said, I like to start pre-marketing for next year's crop once we start planting this year's crop. So I'll be pricing 27 now that we got the planting window for 26 corn open, planting window for 26 beans are open. That opens my door to price some 27 corn and beans. If prices allow me to lock in a gross profit of somewhere in 7, 10, 12% range. Nothing great, but it is a profit, and it does reduce some risk. So, like I said, we're probably a little better than that right now at trading up here close, in this $5 range, and I like that. And that's where I'm saying I would probably be, rather than just price 5% of next year's, say wheat, we're trading $7.25. Well, rather than just price 5%, I'd like to take that up closer to get about 30% price at that elevation, because we're trading at a nice carry into the market. So I think you got to use that to your advantage. Same type of story in the corn market. I think we use that carry and this run up to our advantage and just get a little bit more risk off the table than you may. Worst case scenario, this thing takes off and continues to run higher, and you're kind of kicking yourself because you didn't pause. But I'm not going to complain if I'm pricing more corn at $6, $6.50, somewhere up in there. I'm not going to complain at all. So I will want to kind of beat myself up if I don't price any, and then I watch this thing drift back lower and just
exactly
drift. That's where you really start to beat yourself up. And that's kind of the difference, Todd, between what's happening in the bean market and what's happening in the corn and wheat. So the bean market's inverted, meaning the front end of the bean market is priced higher than the back end of the bean market, right?
Right.
And, that then is keeping me, so, you're trading the July right here, which is the front month at 1180, 1190, say, and you're trading the back end, the Nove, at about 1160. So, and then you go on out to Nove 27, we're only trading at 1130. So I'm not near as aggressive in pricing the back end of beans as I am in pricing the back end of corn and wheat. You see what I'm saying? I'm using that carry. I like using that carry in the corn and wheat market that's currently still there to try and price a little bit more heavily and reduce a little more risk. So no 27 beans. I have a small sale out there that we made a few weeks ago. I think it was in that 11.20 range. We're trading right now at about 11.30. So market's gone up a little from where I made the sale, but it was just a small stake in the ground to trade around. I'm not going to price any more beans at this point. Like I said, I would be more apt and to look at that $5 corn as a nice opportunity, or possibly the wheat at plus $7, $7.25. So that's all I'm kind of saying. I think we look over here at the beans right now. I go back and obviously I kicked myself, Todd, when I made that. I thought I made a great sale and we got sold out of all 26 beans above $11 there, and I had reownership and loaded up and in place the orders, and I just got too greedy. I was trying to rebuy it down there sub 10.20 somewhere down in there, and the market just didn't pull back there. And it had been great to have reownership on top of the sales. I missed it, and like I said, just got too greedy with those orders and thought the market was going to pull back more than it did. I'm still holding some bearish bean option positions. I was talking to some guys on the phone yesterday, and I'll just be honest with you. I had a big put strategy position on back before that mid-March break. So when the market ran way up, and then I put a lot of them on, and then we caught that break in mid-March, and I took a good chunk off, banked all those profits, and I said, well, I can't let this thing turn back into a loser now, thank goodness, because I've banked all this profit. Well, sure in the hell, Todd, I've watched it, all the profit drift away, and I've given it all back on these puts that I decided to keep and hold. Now, I don't know where they'll end up. I'm still holding the December, July bean puts, but like I said, I can't turn it into a loser, but I have certainly given everything back I made, and I'm a little frustrated by that. I'm just baffled. I guess I'm not baffled, but I really have a hard time understanding how there's a lot more room to the upside in the bean market. In each day that they've defended the position and rallied it back, I kind of scratch my head a little bit more. And the reason is just simply this. Yes, there's a strong demand story for crush. Obviously, with crude oil prices elevated, you're going to have bulls come in on the bean oil side. You've ran bean oil to all-time highs, and that's understandable. But I guess I can't get my head around where the bulls see more demand coming from. The crush facilities and the current crush is running at max. Everybody's crushing as much as they possibly can. I want to believe, and so to get more demand from crush, we'd have to build new crush plants, and that takes a lot of time. That takes some time. So, from my knowledge, I don't know of any new crush plants that are scheduled to pop open here anytime real soon. So I'm just saying, I question where we're going to continue to increase demand at the same time. And I know the bulls will want to say, well, we got this meeting coming up with Trump and Todd. Well, do we? I mean, I don't know. I mean, we thought we had a meeting a while back, but do we? I don't. I question it with unless there's some resolution in Iran. I can almost see that meeting getting kicked further down the road. And sure. So then you kick that meeting further down the road, Todd, what all of a sudden, so the end of the marketing year for old crop is August, right? The end of August. So if you bump this meeting into, say, June, or even if the meeting goes down now, I mean, beans got to get loaded. I mean, China still has beans sitting here that they purchased from months ago that still have not loaded and shipped. So I'm just saying, you're starting to run into a time window dilemma as well. I mean, can they even get old crop beans really sourced and loaded and this, that, and the other and shipped to China? I don't know. And I certainly can't sit here in my head and when some bulls are saying, oh, they'll take another 8 million, 10 million metric tons, and I'd really be surprised if they took 4 million metric tons. I'd probably be surprised if they took 2 more million metric tons. not only are they going to pay an elevated price, but I don't know. I mean, it would be a hell of a, I guess, token of faith from Xi to Trump if they did it. So it's hard for me to be a demand bull in beans when I believe the demand's already factored in. The market already has that kind of, I mean, we're already expecting massive crush demand here, and exports are exports. You saw last month the USDA started to trim because they're a little worried about this optimism of the Chinese taking more bushels. So I think there's still more room to cut exports, and you're going to, you can push the crush higher, but you're going to probably take more off the export side than you do, unless President Trump pulls some rabbit out of his hat on this meeting in China and they come back over the top for old crop. But with prices elevated and you're up here pushing $12, it's just hard for me to get my head there. So that's what I'm saying. You don't have really much of a demand story beyond what's already factored in. I mean, hell, you can only crush what you can crush. So you're sitting there and you're saying, I don't know where this new demand story comes from. At the same time, South America, total production out of SAM is going to be another record. So you're going to have record production coming out of South America. I have to believe, I want to believe, and I think that U.S. soybean planted acres are going to get larger, not smaller, just because we're off to one hell of a start. And there's a lot of argument that the USDA numbers, those planting numbers, weren't very accurate when they were released back in March, and that they're going to make some adjustments there. And most people feel that the bean acre number is going to work its way higher because of a few things. It was the year that it should anyway, just from a rotation standpoint. Number two, you've got the higher input costs that may push some people in that direction, and you're off to a hell of a great start on the bean planting, and it makes some sense. So, net, it feels like supply is getting bigger, not smaller, because of the record crop coming out of South America, because of what the acreage we're seeing probably be planted here in the U.S. And without a major weather issue, which we're not going to probably see in the bean market until what? You get out more closer into July, August.
Right.
I just don't know. But I'm telling you now, the funds have certainly defended their record long position. They're holding the record long position, obviously, in bean oil, but they've defended that record long position in beans pretty well. Like I said, we had that big drop in mid-March, and I was sitting there saying, are they going to defend this, or are they just going to, get out of it? And sure as hell, I mean, they've defended it like a champ, and they've rallied it all the way back. And so that the funds definitely want to be long, which is good for us as producers. And demand, I could say demand, there is a demand story, but I think that story's kind of run its course nearby. I think there will be a longer-term demand story, but nearby, I think the demand story's kind of run its course. And then that leads us over here to supply, similar to what I said in corn. And without a weather story that really knocks the shit out of yield to some degree here, here in the U.S., I think we're going to drift. I worry that we could drift lower just without the headlines. But maybe these funds continue to defend and buy the brakes until they see what happens in this meeting with Trump and Xi. And it feels like that's kind of what they want to do, and then maybe they defend it even a little bit more and wait to see how the weather plays out in July. So I've been wrong. I mean, I thought this market was going to break further. Once it broke at mid-March, I thought they were just going to maybe throw their cards in, and it was going to continue to get down there closer in that mid $10, closer to $10. And that certainly hasn't been the case. We've pushed back and gone closer to $12. But I feel you're at the upper end, same way I thought about corn. I feel you're at the upper end, and similar to the back end of that wheat market. I just without major supply side problems, I think you're going to have a hard time continuing to attract new bullish money flow that takes this thing higher. But I also said that a couple of times now in beans. So, I'm willing to admit when I'm wrong, Todd, and
you are. I know.
If this thing continues to work higher, there's nothing I can say except, hey, I'm wrong, and the funds came in with more power and more money flow than fundamentally I thought could be possible, I guess, during this scenario where we're at with ending stocks. I think ending stocks are going to move higher. I'm just saying, just my thought.
So what do you you get 30 years experience, brother. What is your thoughts on why they are defending? I've seen things on the internet.
They're bullish. There's no question, right? They're bullish the crude oil market, and they've been fairly long the metals. Now, obviously, they're trying to turn a little bit. But you have some inflationary. You got a lot of inflationary pressure globally. Like we wrote in the report. I think you're going to see the central banks, the ECB and the BOJ, and you're going to see several of them come out, and they're probably going to start raising rates. Maybe not this meeting, but perhaps the next, just because of the inflationary pressure, and that creates a more bullish type environment for commodities as a whole. And I think there were a lot of headlines and potential, in this bean market, and I think they saw that and they kind of jumped in there. And I think President Trump continues to talk up our relationship with China, that there's going to be more opportunity and more buying, and with oil elevated and crude oil prices elevated and all the crush capacity that's been added in the beans, it makes sense for the funds to be holding a record large position in beans. I'm not saying that doesn't make sense. I could see them making that play and jumping that market in that direction. But I just feel fundamentally, from a more traditional fundamental standpoint, that this thing's overstretched to the upside. But technically it aligns with the bulls. You got like I said, you've got every ingredient that you would want for a major bull market. You've got the technicals, obviously favoring the bulls. We're well above our major moving averages. You've got a good, strong domestic crush demand story, one we've never seen probably the likes of, and you have the funds holding record large fund position. So I just say, you have your ingredients all right there. Now you just need some supply side problems. That didn't happen in South America. And if it doesn't happen here, I think we're overextended to the upside. So,
Well, that's great, man. That's some good stuff right there. Everybody's going to appreciate that. Before we move out of ag, on Monday, the Supreme Court met on the Monsanto and Donnell case. We've kind of laid it out there and stuff. I think everybody knows about it, but I just wanted to touch on it, see if you had any other thoughts or just the implications of how it works out if it falls either way.
That's probably going to be everything, right? If the Supreme Court rules in favor of Bayer, I think, it's business as usual, so to speak. But if they come out and side with the complaint, I think it changes a lot of things. I think you're going to, and I think you're already seeing that, though, be put in motion, right? I think people are fencing off. They're like the Corteva breakup, or like these other bigger, ag conglomerates, kind of the breakup. They're trying to fence off the areas that may have some risk or potential risk. And so I'm with you, Todd. Like I said, I've invested in a few businesses that are trying to find alternatives for weed control and some chemical alternatives. And, I don't know. I think that's probably where the whole industry's headed overall, especially with the See and Spray technology coming on like gangbusters. I think there are going to be some alternatives to glyphosate that come up. So, I think it's probably going to, if the Supreme Court makes the ruling, obviously, against Bayer, it's going to accelerate that entire cycle. But I don't know. I just don't think they're gonna make the ruling against her, but maybe I'm not.
You don't, huh? So is that? Hey, and we'll talk about this later. Is that on Polymarket or Kalshi? Is that going to be a bet? That could be a good bet right there.
It probably is going to be a bet.
Oh, I bet it is. We'll talk more about that later. So Fed finishes up the meetings today with their announcements, and then it's Powell's last. What do you say? You got any thoughts on any surprises he may say, or what he's going to try and leave it with walking out the door?
No, I don't. I don't think. I think he's pretty. I think
he's solid.
Yeah, he's just doing his job that what he believes to be his job, and I don't have any issues either way with any of the Fed chairs or governors, just from the past or present. I just think, I think they got to get in there and they're put in a position to voice their perspective. And unfortunately, we're not all going to agree with everyone's perspective. And, that's understandable. I mean, there were times I didn't agree with Bernanke. There were times I didn't agree, all the way back to Green fan all the way back. There are times I just didn't agree. And I think here we are, and I think people can debate both sides of the argument on where the Fed stance is right now. And I think they've done a hell of a – I'm going to say this. I think they did a hell of a job navigating through COVID, situations through COVID. I think they landed this thing about the best they could land it coming out of there, with all the money that was printed and put in place.
Yeah,
just try and keep the economy supported. But right, we can all sit back and armchair quarterback every team and every play, and so I don't know. That's what I'm saying. I wouldn't want the job. I wouldn't want the position.
No kidding. No kidding.
It's tough.
So what's your? I know you think there's going to be one later. Is that where you're at now? That Max is one cut later, or what's your update for Max? Best case scenario, worst case scenario?
Oh, I think me personally, I'd say you're probably going unchanged to maybe one cut. And the argument is just simply this. They're going to put pressure on Warsh to say, when he comes in, if he cuts, there's going to be everybody and their brother's going to talk about, oh my gosh, the Fed's no longer, we can't trust him anymore. We're just doing what the president wants. So there's going to be that hanging over his head. But I think they're of the belief that that side of it, and especially some of these bigger economists, that, we're going to enter a deflationary period possibly a lot sooner, and it could be a lot more deeper than some think. So they got their eye on that job market maybe a little bit more than the inflationary pressure. So I think you're going to see AI bring a lot of deflationary pressure as things are going to get cheaper. And, in certain areas. So that AI pressure is going to be more deflationary than inflationary, and that makes a lot of sense. But that's why I think you're going to see the Fed give them some slack on that inflation number, that 2% number. I think they're going to let that run hot, but they're going to keep their eye on that employment. And if that employment starts to waver just even remotely, more than it has, I think you're going to see them go ahead and cut a point. They'll probably cut a quarter and then maybe pause, and maybe that next cut doesn't come until 27. But I think they're going to have a dovish tilt to them just because of the uncertainty with AI and employment, how many jobs are going to be lost. And I think that's going to hold weight over this inflation fear, that we could see inflation take off because of the higher elevated energy prices or oil prices.
All right. You touched on labor. You said if labor, starts getting handled a little bit more, they'd have to do something. But Kevin, we ran that story in the Wall Street Journal the other day, and it showed the breakdown of the year on year. The numbers weren't that big, but 40% of the people getting let go were from tech. I got to believe this thing just starts accelerating more to where labor is going to be an issue. Any thoughts?
Well, I think initially that'll be the case. I think longer term, though, that new jobs will be created, just like every other, they call this the fourth revolution here, industrial revolution time. That's the tech revolution. Here we go. I think more jobs will be created, net. But in the initial phase, I worry that you could lose quite a few jobs, and the retooling process could be a little tricky. And so I think you could see people out of work for a longer, extended period of time, which is worrisome. I'm with you, which is worrisome, Todd. I just think that's the case. So I wrote, we were talking, I was on the phone talking to folks, and it's interesting to think that this will be the first time in American history that our kids will go to school and train or earn a degree, or maybe go to a trade school and train and learn something. But the odds of them being able to do what they've learned there and that skill they've acquired for the next 30 years through retirement is probably slim and none. I mean, think about that. I mean, what they're going to school to learn to do is probably they're not going to be able to do it for 30 years. I mean, that probably won't even exist. I don't care if you're a doctor, dentist. I don't know. I'm just telling you, I think all that will change dramatically. I mean, an architect, engineer. I mean, I think, yes, you're going to go to school, you're going to get your degree, and you're going to get out and you're going to get a job. But then I think almost at any time during that next 30 years, you got to be kind of a nervous Nelly wondering, I wonder if one of these robots in the way they're coming on are going to take out my position, right? I mean, I think that's the fear and the worry. So I don't know. I don't know what the right answer is. I know you're scared and nervous about it. I know my wife she thinks it's all for the bad, right?
I'm sorry. Oh, go ahead. Sorry.
Go ahead. No, finish. Go ahead.
I was just going to say, I said this earlier to you, I'm starting to become in the camp that I think this time may very well be different, meaning that the new jobs aren't going to be there like they have been in the past because you don't need the humans to do that. I mean, the roles, machines couldn't do those things in the past. The creativity, social intelligence, physical adaptability, blah, blah, blah. Well, now, I mean, they can't. Hell, they're writing the new codes. They're writing the new things. It's going to be interesting. I'm not convinced that this time's going to be the same, that it will be a new job. So just with the way we're going. I mean, hell, you just wrote a story the other day. We're using brain cells to do the next chips because we're going to save space. I just say, think how fast we've come. You write this a lot. How fast we've come from here to here to here to here. Think about the next 15 years of advancement that it's going to have on technology.
That's the whole dilemma. It isn't the technology, it's the speed of change that has everyone so
right. What do you do with it?
We've been talking about that for several years, that at some point we're going to hit this inflection point where the speed of change just becomes so incrementally large that it is hard to make an adjustment. And that's kind of what I was saying last week. And it's like, if you're investing in something, you got to be super careful. And I've had several investments run across my desk as of late, and I just scratch my head. I'm like, there's no way. And there's no way possible I'm investing in anything software-based
right.
at this point that's a startup. I can't do it. And I've had so many deals come across my plate that 3 years ago or 5 years ago, I would have probably done in a heartbeat. And you sit there now and you're like, holy smokes. And some of these people that have built some interesting software businesses inside our space, and actually, I mean, they've got to be sitting there as nervous as can be. I know I would be. And I just think lots of things like that are just going to dramatically change. And it may be a change for the better for one or two of those companies that are out there, and they may end up being the entire leader of it all. But I think it's going to weed a lot of people out, and I think it's going to really shift and change a lot of business models and dynamics, and that's where I'm hesitant. I'm being very, very cautious on investing in anything that has to do with technology from my end. I just don't have enough money personally to feel like I can go down that path comfortably and continue to feed a company that would continually have to reinvent, because the guy next door, his company is on to the next new thing, So I just don't want to be chasing that, and I'm not going to be. I felt like I did that a little bit in the .com era, and you'd invest in a company that came out with something, they released version 1.0. Well, the next thing, there's a company pop up on the other side of the country, and they've one-upped you. So now you've got to go and refuel and go back to the drawing board and try to overcome theirs. And now you're at 1.3, and it's just a very, very costly process, and one that I learned, kind of if you can't run with the big dogs, don't get off the front porch a little bit. And so for me, I know where I think I know where I fit in. I don't have that kind of money, and I don't want to take that length of time, or I don't want to put that many of my troops at risk, which I'll call my money, and I don't have the additional troops to really go in and back those up when I need to create new versions. So that's where I'm a little hesitant. I'm trying not to throw money that way, even though that's the sexy, buzzy stories and everyone wants to be involved in. I'm actually pivoting the other way, and I'm trying to take more of like the Cass approach, the gentleman we had come speak at FarmCon. I'm trying to lean more into the human experiences and where I think AI is going to drive more people to human-type experiences or the blue-collar type of space or things of that nature, where it's, agritourism or building out more rec hunting ground or leaning into our FarmCon conference, places where people are going to come gather and be a part of humanity. I'm going to lean more into that and take my money and go kind of into more plays like that. And you've seen that with, whether it was my investments into TKO, which I've told you owns PBR and owns WWE and some of those live events, or Live Nation, which is the ticket sale company. We've been long that for a while, or things like that, things that build community. And just like I said, more investing more into where there's more human touch. And I'm trying to keep my dog out of the tech race just because, like I said, I can't afford it. I'm probably not that investor where some, billions and millions of dollars, you're the guy out. I mean, you're leading that charge, and that's great, and you're probably going to make billions and billions of dollars. But it's just probably not the space for me personally and my family and the age I'm at. So that's how I'm playing it.
Well, so along that line, when you're not invested in tech and more blue collar and stuff,
I think big. Now listen, I am invested in big blue chips,
right,
and that's where I have almost all of my equity money. I mean, so I'm just telling you, I think you're going to have a hell of a tough time beating the incumbents, and because they have such cash piles and they already have a big lead. So that's all I'm saying is I'll stick with. It's just the same in the equipment space. I'm gonna put my money with John Deere, or I'm putting my money with the big incumbents. I'm gonna be hesitant to go throw my money to a startup that's doing robotics. I'm just not gonna do it. There's no way. And
that's interesting.
I played that game in the past, and I can't do that. I'm not gonna do that now. Now maybe if I was 30 years old again and had a lot of time and had a lot more money, maybe I might make that play. But that's not where I want to put my chips.
And that makes a lot of sense with where we are in the game and who's got the head start and doing some of that.
That's the sexiest story, and that's the one that's going to attract the most people right now. And everybody's going to want to throw some money towards, there's this company started up this robotics, and they're doing this. And I don't want to take nothing away from them. That's fine. And I think there's a chance one or two of them are going to come out massively successful. But I'm just telling you, I don't want to be the one feeding the people that are chasing and more capital calls. And, I just don't want to play that game again. Like I said, I feel like I did that a little bit in the .com era, and I didn't do very well. And I didn't have enough dry powder, to be honest with you, to continue to fuel that chase. And I think that's what I'm going to get into again. And I worry that's what you could get yourself into if you start to go down that slope or path with someone who has an idea that's very tech savvy or tech heavy. There's going to be some heavy duty competition in that space with deep pockets. And do you have the sharpest and fastest horse, and do you have enough money behind you to win that race? That's where I don't know about that. You see what I'm saying?
Yeah, so let me ask you this. We're sitting there, we keep asking ourselves, how long can consumers keep spending? You mentioned some of the investment things. You're talking about the experience things, which I think is probably the best thing we do for the rest of our 20, 30 years we live, because they're going to be there. But is the things you're talking about going to have to be catered to the top 10% of income earners because that's where the money's going to be spent? If you're going to be doing this like the land and recreation, stuff like that, or do you think there's other places?
I mean, sure, you can cater to that. I mean, I don't know if that's necessarily the case. I think people just send them differently these days. I mean, I just think it's, too many people get tripped up in the data and looking at data and then massaging that data to fit their own perspective, their own mindset. It's like when you'll send me shit that says, credit card balances are at their all-time highs. Well, no shit. I mean, obviously. I mean, inflation, I mean, prices are at their all-time. I mean, cheeseburgers at its all-time high. So, it's all relevant. Credit card balances in the 1960s or 70s obviously weren't as high as they are today. And it's, I love this one when I get this data from people. Google searches for looking for a new job are higher than they've been. Well, okay, yeah, higher than they've been. Yeah, because nobody in 1990 was on the computer really searching for a job. I mean,
I hear you.
Of course they're higher. So I'm just saying, data can sometimes be a little tricky. I think people just spend their money a little bit differently these days. So yeah, there's a K economy for sure, but I think there's plenty of middle class, and we've seen that. We've seen data that shows the middle class has gotten wealthier and wealthier, and so I just think people are spending their money a little bit different. I do think it's interesting also to think about how much less reliant we are on gasoline as far as a percentage of our overall budget as Americans, and so this higher fuel price isn't probably, taking as big a drag on the economy as it would have, say, 20, 30 years ago. And that's interesting to me, just because of, like I said, there was a paper out, a trading paper, more items are getting delivered to households. More people don't have to go out and pick things up. Way more people working from home, or some flex hybrid of work from home, or some type of thing like that. And you have a lot more fuel-efficient vehicles on the road. You have a lot more hybrid flex vehicles on the road, and you have some EVs on the road. So, net, we're just not as reliant from a budgetary standpoint, U.S. consumer budget, on oil as we were, like I said, in the 70s, 80s, 90s, somewhere in there. So it's just interesting how the spending shifts and ebbs and flows and changes. But I do think there is going to be I think there's going to be a big demand for places for people to go and interact, and as you get more AI robot type things, people, more robots in the workplace means fewer people in the workplace, and I think that means people are going to look for more things to go do and to stay busy, and those are probably where I would like to spend, invest more of our money in that directions.
Well, let me ask you about this. You see an opportunity. Administration came out recently and said they made the energy infrastructure a national security item stuff, and they were kind of leaning towards that since earlier in the year. But are there plays there? Do you not play that game of potential companies where the government's going to invest in or push an agenda?
I prefer not to. I mean, that was, again, another layer of risk. On that deal I had that came through, that we were going to loan money to these tech startups that created military-type items, created military weapons and things like that. And there's not a lot of banks that will loan those people money, but we were going to provide the bridge, a group provide a bridge to that. And I number one, I see a lot of elevated risk because it's in the tech space, meaning, yes, we could loan this person money on a 10-year note, but in 10 years, I mean, this company could have been out of business within 2, because just as fast as technology is moving, right? So I think you got to be careful there, how fast that tech's going to change. But I also felt there was another layer of risk added on as well, because it dealt with the government. And if the government flows, I mean, how would you like to loan a bunch of money to some of these climate companies, Todd? And then 4 or 5 years ago, and all the ones that we've seen go out of business on the shift when Trump and the Republicans took and swept. I mean, so that's what I'm saying. I think you got to be careful on the tech side, the real heavy tech stuff, because, boy, you just have to make sure you've got a horse that has all the right everything. The right jockey, the big money behind it, the right state. So on that tech side, you really got to pay attention to that. And then if it's got a link or tie into politics, I go the other way. I don't want to invest my money in that. And a lot of people come out and say, oh, my gosh, they got a government contract and they're going to do that. Yeah, well, I don't want that, because that worries me, because that could change also in the blink of an eye. So, if that came along when I was investing in a company and we got a government contract, then maybe I'd consider it more of a little bit of a windfall. But I'd be hesitant if that's what they're pitching you, like that the government, this is something that these government contracts, this, that, and the other, and this technology. I would be hesitant just because I see two layers of risk that I don't like. They could change.
Yeah, you said that before. Well, on an investing question, kind of moving into one of your stories today in the report, you wrote about what everybody needs to know, how event contracts move into commodities, and how contract platforms like Kalshi. So explain what's going on so everybody understands, and then just the broader implications of some of this stuff and what it's going to do to the potential price discovery and stuff like that, if you would.
Well, I wish I'm probably not by any means any type of expert. I do have a call with Kalshi CEO, Jordan and I, coming up here, I think next week or the week after. Jordan's trying to get him to come to FarmCon and sit down and talk with everyone and explain some of this. But we're also, we got introduced to him from Anthony Pompello, and he's hooking us up to try. The Kalshi wants us to give him some advisory type counsel on some of these commodity type contracts and what to look at and what not to look at, and darn grain, corn, beans, wheat, things like that. But we'd love to have him come to FarmCon or have their team come to FarmCon and kind of really just explain, but no more short term like OTC, over the counter type bets and trades. Pretty much anything. I included links to all the various platforms out there that are currently, making commodity type bets or commodity. I don't even know how to, say the proper term. I don't know. Are these bets? They want to say this isn't gambling, this isn't bets. It sure the hell seems like bets to me. Will corn finish, the day over $5 or will it not? There's your bet, and you can put, wager what you want on it. And will planted acres go up? Will they go down? I think you could start seeing anything and everything out there, and there will be ways that you can use that to hedge, obviously. Just like with when eWeather came out or spun out of Enron, we helped eWeather kind of get going. And, they were weather contracts, Todd. And you were taking insurance. It was basically, they call it like insurance on weather. Will it rain or will it not rain? If you had an event, you could bet that, let's bet that it rains, and if it does rain, your bet pays off. You see what I'm saying? It may cover the cost of your event that got worked out. So, it's like, will a guy hit a hole in one? Will he not hit a hole in one? And you make, the bet vice versa on that. So, I think it's interesting. You've seen it all in the headlines. What where the U.S. military guy bet that Maduro would be captured, not remember whatever, and he now on in trial for insider trading. Obviously, a little bit of insider info, but. No, I think it's interesting. I've played around with it a little bit, but I've personally never done anything. And I think it's just because I'm old. Back in the 20s and 30s, I'd have been all over, and we'd have been making all kinds of bets, you and I, back in the days, and telling each other our bets and all this, that, and the other. And my daughter and Jordan, they say all their friends are all on this stuff all the time, making bets and gambling and wagering on all this prediction markets or whatever it may be. But like I said, I just haven't. I do think it's interesting to look at, and it's almost better than a newswire service or a because you really can tell what's the hot topics of the day and what's what is moving markets and what's, I guess, being most heavily debated. And I do find that very interesting, the topics and the bets that are being placed. And I guess I'm probably not even using the right terminology, Todd, because I know they don't like calling it gambling or betting, but it's what it seems. What it is. It seems like that to me. Part of that, what they call the whole degenerative economy, right?
But from a trading standpoint, you've been in the markets for most of your life. Is it? And it's going to be 24/7, as I understand it. And a little bit I know, they say, hey, man, the future markets close, at night for a reason, this and that. And it's going to create some liquidity potential issues or price discovery issues where there's big gaps and stuff. Is that a concern to you as a guy in the market that needs real information? Or is this going to be another tool that's going to actually maybe
I don't think it's going to create any issue. I mean, I think your smart people are going to figure out a way to arb all that. They'll be able to, put a trade on over here at the Board of Trade, say on the CME, and, maybe you see something on Cali or something else that's out of whack because of the way people are betting over there, so you can maybe cross-hedge that or arb that somehow. Like when E-minis first came out, or the electronic trading first came out in the S&Ps, and, the price difference at times, there would be some fairly sizable differences in the price of where the electronic was trading versus the price of where the physical was trading in the pit, and you could arb that and make that difference. And I'm sure there's going to be a lot of smart people out there that are able to set up those types of programs from a technology standpoint that, they constantly are monitoring all of those platforms. And when one little thing gets slightly out of whack, they put their position on and they capture that juice. And it's, I think there's definitely going to be those people out there that make that happen. It's above my pay grade. I'm not going to be the person that builds those programs and puts that in place, but I certainly understand that. We were part of that several times with groups throughout the years that where technology came on, it created, like you're saying, it created some wrinkles, and we were able to take advantage of the opportunities in those wrinkles that were created at times. But I'm not a part of that right now with any group. But I'm just, and I'm saying the reason I'm not probably, Todd, is like I said, because I'm older and I'm not hanging around, the 18 to 25-year-old, programmer that really knows this AI and really build those programs out that can track each platform in real time and can make those changes and adjustments on the fly. So, but I'm sure that's out there, and I'm sure it's going to be something that some groups are able to take advantage of.
No doubt. Today, as you do annually, kind of shared some of yours, tried to give some advice to the graduating classes that are coming up, and threw some information out there from Hunter Thompson and stuff. Share, because one of the things that you did that I highlighted as we're thinking about, like you mentioned earlier, jobs going out of style is, the skill set never goes away is how to be a better thinker and stuff. And talk about the degrees you like, why you think that's important. And then I'm going to throw at you, is it really going to matter, once again, going forward, if we're going to be outthought by technology? But lay out your advice to the kids stepping out of high school and college.
Well, no, I think it's similar to my own personal advice on my investing. I said 5-10 years, I don't know, maybe 10 years ago, I said, if technology is going to come on like gangbusters and it's going to be the rate of speed of change that really throws us all for a loop, which I suspect it is, rather than try and forecast where that change is going to happen or how it's going to happen, I wanted to look at the negative space and say, okay, what isn't going to change, or what are the things we know are probably going to stay stable? And to me, that comes down to investing in things like air, water, food, shelter. I like all of those. Shelter, including your blue collar space, like your HVAC, your plumbing, things of that nature. Air, I like the air, meaning I like the HVAC companies, the companies that are going to, detect when COVID's in the air, or purify air more, or cool the data centers, or create airflow that cools or liquid cools some of these. So you start thinking like that, and you start to say, air, food, water, shelter, and then you make your plays kind of accordingly. And so if you take that same type of mindset and you say, okay, my kids are asking me what would be a good degree to go get, I think you try not to. What most people are going to do is try to forecast the future. And like everyone that said, you got to go be a computer programmer or something. Well, hell, they're all going to be out of work. They're all going to be out of jobs. So that didn't work out so swell, I don't think. So I say look more at the negative space and what can I do that isn't going to go, isn't going to be taken over that. And I think you've got to become a better thinker. And a better thinker is someone that can put processes in place to get the most optimal outcome in life. And I'm not talking just money. I mean, that to me, I mean, I don't know. I've seen a lot of people give a lot of people praise because they had a lot of money, but their life was a complete shit show. And I can't get there. So, I think first and foremost, like, I love that 60-minute interview with Sass over the weekend. And I think first and foremost, you want to try and be a good person and a better person each day and try to be a better spouse and a better father and better grandfather. And somewhere down the line, business comes into play, or I guess the success of money. But money to me is just simply a byproduct of some of the things. So like I said, I don't like hanging a hat on how you've succeeded in life based on your job or your money. I don't see that. I think you need to view your kids and your family and people, how successful are they at life, just in general with life. And so I like to tell the kids to go to school and try to become a better thinker. I like the degrees in literature. When are you going to go read the old classics? If you don't read them then, when are you going to have time in your life to really buckle down and read them? And philosophy. These are places that I did not know any of that. I was weak in those areas for sure until I got older in life, and I wish I would have had those types of degrees. And I look at some of the great CEOs and some of the best leaders, and I told you the best lawyers and some of the best thinkers that I've ever been around. And they all I'd ask them, I'd quiz them all, what are your degrees? And it was English, philosophy, and history, literature somewhere in there, and those were always their degrees. And I just feel they're going to have an edge. And I think you go to get a business degree, I don't really think you're going to have an edge just simply because AI can probably spit out and tell you everything you want to know way better than you're going to come out of that school with that degree. Nothing against the business degree. I'm just saying I think AI is going to be, just like my daughter with an architect degree. She's got a master's. I think AI is going to overtake that. Now, has getting that degree helped her become a better thinker? Sure, for sure. But throwing her in here and having her run a business or two and deal with some real life things, that's really helped her become a better thinker and build a team and manage people and things like that. So, I think any of those things that can help you just think through things better and build processes that allow you to think more clearly are going to give you a real decided edge over the other people who are going to rely on what I would call, this is where you're going to say, well, what, AI is going to do out there. Okay, but they're all going to be using groupthink. I mean, they're going to all be typing in their question into AI and all have the same exact answer and perspective. And I know in life, it's all about perspective. And you can't tell me that AI is always going to have the right, or it's going to just have the exact right perspective. There's no possible way. So I think that's the key. I mean, and I think that's the key to knowing where things are offsides or out. And then when they are offsides or out of bounds, that's when you can, you feel you can have an edge and you can capture that and have some success. It's either there's not enough of this that's needed, or there's too much of this and less of it, and that's where your advantages come into play. So, I think you got to just, it's like a kid starting at, elementary school and junior high. I mean, what the hell are you trying to tell a kid to be? I mean, you don't know what's going to be out there in 10, 15 years. So I think that's just the play, is just really work on, mind strategy games, different things that just really help a person gain multiple perspectives. And if you think about it, that's the real reason I push the history, the literature, the English, because you read a book written by whoever, a classic. I mean, they're going to have a much different perspective than the book you read over here by this person. And that's what you're trying to do, is get your mind to become flexible enough. That's the key. And so where you're in your math and science degrees, that's not building a flexible mind. That's building a more structured mind. And that's fine. That's fine for the people that's what they like to do and that's what they want to do. But I'm just telling you, I think to be successful, more successful, and make sure you understand. I'm talking if we had a 500,000 people in the room, 500,000 over here with these, that think like this, or 500. So I'm not saying you're specifically, your family, your person, or whatever. I think there'll be a lot of engineers that'll do great. I think there'll be a lot of chemistry and science people that'll do great. But I think if I wanted to place my bet, I'd like to engineer or build a person or a child that was just a lot more mentally flexible, because I've said this before, doctors and engineers are by far the worst traders. I'm just telling you now, and I will go on record with that. And the reason is they're not that mentally flexible enough to get off of losing trades a lot of times. They believe like they're right and it's going to be right, and they'll continue to add to that. And a lot of times they ultimately do end up being right, Todd, but the market, they're ahead of the market, or you see what I'm saying? They can't just get off of it, and they can't let go. Because they know they're going to be right, and they end up. It's like that Michael Burry guy, the Big Short, right? Well, shit. All that had to happen is that break doesn't occur. Say the break in the housing market doesn't occur for 2 or 3 months later. Well, Michael Burry's broken out of business, and everyone's saying the guy's an idiot. But it happened just at the right time for him, and he looks like now the greatest trader that ever came out. But if you look at that, he was holding those losing positions like they were going against him like crazy, and it just happened that it worked out. But for every one of those guys that it works out, there's probably 100 that it didn't work out for, just from a timing perspective. You see what I'm saying? So that's all I said. Doctors and lawyers, I've seen doctors and lawyers lose more money trading than probably anyone, just because they're not as mentally flexible, and they do believe they are super smart, which they are, but sometimes that works as a little bit of a hindrance, because they sit in their head and say, there's no way this can possibly be happening, because 2 + 2 has to be 4. You see what I'm saying? And in the markets or in life, that doesn't have to be the case, Todd. 2 + 2 does not have to equal 4. And I'm just telling you, that's where it gets tricky. So,
well, that was one of the first things you and I, one of our first great debates when we traveled around while you were speaking, was art versus science. And I coming from the golf background and teaching this, you'd always say, well, if it was all science, everybody could just read and watch the Tiger Woods video. I'd still debate that, but not everybody has the talent he had to do what he did with his body. But with that said,
that's why they wouldn't be great.
Well, yeah,
story. To be great, it takes a lot of art and a little bit of science. To be good, it takes a lot of science and a little bit of art. So I'm just telling you, to be great, more art, less science. That's what I've seen. And that's it. So.
Yeah. Well, as a teacher of golf, and you can relate this as a parent or any sport or any skill set. Yes, I would allow the person. I would now go back and allow the person to. I'd look at the overall macro natural movement stuff before I start jamming them into where they feel like they're handcuffed, because they're thinking what he just tell me to do instead of me just watching. So it's interesting stuff on that. Let's do this. Let's finish on this. I didn't really talk about. You got earnings calls that happened. Big ones this week, and you're involved in some of them. You got any expectations on what this is going to tell us in regards to the continued AI CapEx spend, and are we going to make any money doing it? Or are they going to make any money doing it, spending it?
Yeah, I don't know. I think that's the big question. We're trading a little bit rich here at all-time highs there in the market again, and we've rebounded, had a hell of a rally back. And no, I don't know. I'm just, I think, again, I think what I said at FarmCon and what I've said throughout the first part of this year is, I think it's held true. I think you got to look to be a buyer on the breaks of big blue chip stocks. And they've notoriously been extremely volatile, meaning I'm not probably going to buy NVIDIA here at the all-time highs or own it right now. I think I may be able a little bit. Because you always get an opportunity to buy it at a break. There's been plenty of opportunities in all of these stocks. It doesn't matter what it is. I don't think you got to get crazy worried that the train's completely leaving the station. I think there's going to be opportunities because I think demand's going to be strong for the right companies. And in demand-driven markets, the train always comes back there. You get a chance to buy back in. And that's what I'm saying. You've seen Microsoft come under a lot of pressure. I don't mind buying some of it on a pullback. Like I said, I don't really want to be buying these at all-time highs. Just because I think you're going to see some opportunities or throughout the ebbs and flows over the next few years. The media will get a hold of the next horse and say, oh, it's going to win the race and this horse is going to win. I do think it's interesting that I think we're coming into a little bit of a money flow issue and concern. And I'll just, we can wrap up this comment. I'm just telling you, you're watching how some of these other stocks are performing, say like J&J or Eli Lilly or some of these other stocks in Raytheon, Honeywell, how they're performing after they release earnings. They're going lower. And that makes me worried that we have a little bit of a money flow issue that we did kind of see in the dot-com era, meaning the money coming in, there's enough money coming in to chase the high-flyer tech names. But outside of that, there's really not that much interest in anything else. So now you're gonna bring on a few IPOs that are gonna attract crazy money, whether it's SpaceX, Anthropic, the OpenAI IPO, and that's gonna pull money away from the incumbent tech that's currently in play. So I'm a little bit worried that we're having so much money chase so few of opportunities, meaning mostly just pouring into picks and shovels for AI. And, the actual hyperscalers and the AI players that are coming online in IPO, you're seeing some of these other stocks and companies that have been doing really well move lower. And that's worrisome to me. And that's a little bit worrisome. So, I'm still sitting here, not really, I'm overweight cash. I'm not overweight the market. The majority of my positions are in big blue chip tech. And, I am still holding a fairly sizable position in Eli Lilly that I like longer term, but it's just not that sexy of a story right now. And all eyes and all investors seem to be pushing money, and money managers want to be in the sexy stuff, right? So they're pushing it all towards the AI plays, and yes, that makes you worried. I mean, it gets frothy a little bit, so. I just say be patient, look to be the buyers on the bigger breaks. I don't like chasing the rallies higher, and just, play your hand that way.
Last question is a simple yes or no in relationship to trading. So you said with the other topic we were talking about, it's if you're going to be great, it's 90% art, 10% science. So in trading, if you're going to be great in trading, take the fundamental view, technical view, and do the split between being great and being good. What's the numbers? How they divide it up then? What's percentages for that?
Oh, the greatest traders I've ever met and know. I mean,
yeah. What percentage are they?
I don't know. I'm not saying there's no. I will say this: I've seen some purely automated technical trading programs. I have seen them get hot at times, and they'll have some will have a 6-month run, some will have a 2, 3, 5-year run. I haven't seen many with a 5-year run, but I've seen some with 2 and 3 year runs, and they get hot and they work. But then you start to get into the optimization and all the things that nature. But again, I think it's like I just said with marketing earlier in the podcast. I think you have to find what works for you, because. Yeah. I'm like Stanley Druckenmiller said. I think you got to be a good trigger. And Druckenmiller hung his hat on saying he's a good trigger man, and I think that's what you have to be. And that comes with a lot of emotion, a lot of psychology, there's a lot of everything involved. Just like I said, I don't think doctors and engineers make good triggermen because they hinge on too much of the data and too much of the math. And a good triggerman, to me, there's a lot of subconscious things at play there, and they just kind of know when to get in and know when to get out. And I think a lot of times they have a hunch, or they have a feel, or like the guy in the river with the kayak, he's got to get a feel for it. And it's like being a good golfer. And some days you go out there, Todd, and you just feel great. Your hands feel good. They feel thin. You can make every putt. Your short game feels, and you got a feel for the game. And when you're in that rhythm, how long? And you and I both played golf at a high level, and we've played other sports at a high level. How long can you stay in that rhythm, Todd? It may last a day, it may last a couple of weeks, but you know what I'm saying? You're in the flow. You're just really in the flow.
It's usually a 9-hole last for me, but I'm with you, brother.
No, you know what I'm saying, though, right? Yeah, it can come and go.
No, it's so true.
It's the same in everything, and I think that's the same in investing and trading and whatever it may be. You get in a rhythm with it, and you get in the flow, and you're feeling good, and your family life's good, and you're hitting on the cylinders at home and with the kids, and then all of a sudden, the Tiger Woods moment happens, or something, and all of a sudden, your family life, and the kid, you got a kid that's sick or is a struggle, and the next thing, your mind isn't, and your subconscious isn't jiving. Things just aren't aligning, and when that happens, in the trading world, investing world, you just got to walk away. You got to take a break, and you got to know when to just shut it down and then get realigned. And so that's what I'm saying. I think there's a lot of what we can't put in an equation, or we can't put a number on or a value on that is the key to being great at something. And whatever that it thing is, that's what I'm saying. So there's a lot of things.
Good stuff, brother. Man, always good content when it comes to investing perspective, and always boils down to the family and having a process. So appreciate it, Cabby. Got nothing else for this week, so we'll look forward to talking to you next week, and have a great week, man.
All right, buddy. Have a good one. Talk to you guys. See you.